There's this narrative in Bitcoin you might have heard of. It goes something like this. Diamond hands never sell. Real hodlers hold forever. Selling is for, weak hands. But when you actually look at the on-chain data, that's complete nonsense. Long-term holders, the people who've been in Bitcoin for years on end, they do sell, not all, but a lot do. And the crazy part is they're really good at it, actually. So these are the people who've been in Bitcoin for over 155 days, right? That's how we define a long-term holder in the on-chain world. If the diamond hands narrative were true, this is the realized profit and loss by age band. So we can determine, which out of which groups are selling or realizing profits on chain or losses, right? So if they were taking no profits, if no long-term holders were selling, then this would be a zero. This would be a straight line. Nothing would change, right? The thing is, that's not what the data shows. There's massive spikes throughout Bitcoin's history where long-term holders are taking serious profits. The thing is, their timing is almost always perfect. If you look at previous, cycles, if you look at 2017, you can see on an absolute basis, in a USD denominated basis, people were selling back here. Similarly, in 2013, you can see the same thing play out. In the first peak in 2013, in the 2011 cycle, which is kind of not a cycle, but whatever. I like to look at this on a USD denominated basis. Most people are seeing those sweet, profits in the dollar, or pick your degrading currency of choice, right? But it's a little more psychological when you look at it like this, because the absolute numbers denominated in the currency or USD are much higher. You can also denominate it in Bitcoin if you want, which shows it in Bitcoin, and how many people are realizing losses or profits on a daily basis in actual BTC terms. So today I want to look at something on the website that's a little bit experimental, but if you're not familiar with this metric, this isn't the one that I'm going to show. This is the one I'm going to show. But if you're not familiar with this metric, the long-term holder profit to volatility ratio, it's basically asking how extreme are these long-term holders that I was discussing, how extreme are their unrealized profits and losses relative to typical market volatility in Bitcoin. Here's another way to sort of think about these on-chain metrics, because, let's be honest, they're extremely niche. Not many people know about them. So I'll sort of try to explain it from a different perspective, right? Let's say in a hypothetical world, every, financial asset was fully digital and fully transparent, same as Bitcoin. You could see what everyone in the world is doing with their assets, whether we're looking at gold, silver, S&P 500, uranium, NASDAQ, anything, right? If we could aggregate all of those profits, all of the losses, who's calling up the brokers to tell them to buy or sell everything, right? I'm not telling you should do that, but of everyone in the world, right? In my opinion, I believe you would see sort of a similar situation to Bitcoin when calculating these sort of metrics. Everything, especially like MVRV, the market value to realized value. The thing is, we can do this for Bitcoin, and we can do this for other cryptos too. We see that these long-term holders realize profits on chain, whether they move it to exchanges, send it to another wallet, or there's consolidating UTXOs. That all counts as either, realizing either profits or losses. And you can argue that's not good enough. You can argue that you only need to show the entity adjusted metrics like Glassnode has that, the exchange balances, but I'm just looking at it from an entire market perspective. I'm aggregating the entire market, right? So we can also see the opposite, right? We can derive not only the realized profits and losses, but we can also derive the unrealized profits and losses, which coins have not moved, right? You can see the exact information within a 10-minute time frame, because every block on average takes about 10 minutes. So in this chart, I'm aggregating it on a daily close perspective. So I was gonna touch a few things on this chart actually. So this is the long-term holders profit to volatility ratio with a 1-year moving average, which we can sort of define as sort of a momentum oscillator. If you turn on the binary momentum indicator on the chart, you can see that whenever this sort of goes into high extremes that can typically correspond to market tops, You can see that it happened in 2017, sort of in 2021, the first peak, and it's also been happening this cycle and in all prior cycles, right? So in this chart, I want to show that, when we go below this 1-year moving average on a daily basis, it can correspond to either holding support in the bull market or not holding support in the start of the bear market, right? We can see this occur in 2014 when we sort of broke below it as a fake out, had this sort of double top, and that sort of marked the end, and then we broke below it, right? Similarly, you can see the same thing happening in 2018 when the bull market had already ended. We tested this level of the 1-year moving average, broke above it, couldn't hold it, so we fell back down, and sooner or later we hit this bottom. Same thing in 2021. We held it as support instead of falling below it. We hit a new all-time high, and then we broke below it at around 47K, and that's when momentum sort of shifted to the negative, right? So you can see it shifted to the negative. And you can also see in bear markets, once we're getting out of those territories and sort of people are experiencing more profits and not as many people are sort of having the same PTSD as the price always goes down, it starts to get a little bit more positive and momentum starts to shift to the upside, right? So this cycle, we've actually seen it hold 2 times, which is unprecedented compared to any other cycle, at least. So not maybe a little bit in 2020 when we held it twice, but in my perspective, I think if you see this hold, I'm not saying it has to, but if we see this breakdown, if we see Bitcoin break down even more so from this level, this is a key level that I would be watching for, especially some other on-chain levels. If you look at this chart, you can see that the short-term holder cost basis is sort of breaking below this level right now, but it's also broken below it a few times this cycle, and that doesn't necessarily mean the bull market's over. Just because this broke down, it can just mean that short-term holders are sort of experiencing these losses, a majority of them at least. So yeah, that's my perspective on this chart at least. So this is the chart I really want to talk about. So this is the long-term holder profit to volatility ratio, but I'm using percentile distribution, and I'm mapping that from the 2017 high, because if you look at it from a non-smooth perspective, you can see that sort of the only outlier in this entire data set was the 2017 bull market. So looking at the 2011, it sort of peaked at around 3.75, 2013, 3.8, around there. In 2021, it peaked at around 3.6. And in this cycle, the highest we've seen, I think it was around 3.25. And so once we map it to this level of 2017, we get a chart that sort of looks like this, right? It's still using the raw values to create a standardized 0-to-1 score with percentile mapping, but it's still using the basic raw on-chain data from the original profit to volatility ratio. So I want to sort of analyze this chart in terms of the risk levels that I've sort of printed on these charts. So currently, there's only been one level of extreme risk above 0.95. That was when we hit 124K. If the top is going to look anything like the past 3 cycles did, then it would generally be more risky. So for example, in 2014, we saw around like 12 or so readings. And then in 2014 or in 2017, wait, did I ask this one? Yeah, that was only 2, but I'm just going to look at these ones. So in 2017, I think it was around like 30, right? And then in 2021, the first peak, we saw around like above 15, I think, levels of high readings. And then in the actual peak, there was around like 30 off of memory. So you can count them if you want, but I'm not going to sit here counting them. This cycle, we've only seen one miserable, measly red little dot. So like I said, this is a little bit of an experimental indicator. We could just have this one flash, or we could see that Q4 rally like everyone's talking about. Honestly, guys, I'm not going to tell you exactly what to do. The only thing that I know for certain from my perspective is that we will see a 2026 bear market, and I'm going to stand by that. I don't think the 4-year cycle is broken. I could be wrong. Who knows? I stick by the data, and the data suggesting that it has happened and it can happen. So there's always that possibility, right? In my previous video, I actually talked about different support levels that we could face, right? So this is the chart to check out those levels. So if we look at a couple of these levels, if you're interested in learning more about these charts, by the way, all of them are free on the chartinspect.com website. So yeah, you can look at all these levels that I talked about in the previous video. And you can also go onto the exhibits section on the website, which is right here, where you can see sort of curated sections to learn from. If you're interested in diving, deeper into the data, everything is pretty much laid out for you to learn. So at the end of the day, in my opinion, without being too explicit about what's going to happen in the future, liquidity moves in cycles, right? We've seen this in multiple phases, in multiple markets, not just Bitcoin. It's prevalent in, the stock market and gold, in all assets, right? You see these phases. So regardless of what happens in the future, I think just looking at the data and keeping yourself level-minded, you'll do fine. Just, nothing's for certain in this life, and I can't tell you the future. The data can't tell you the future. All we can do is sort of look at the market that we're in and try to make our best guesses at what's going to happen. So anyways, this video is going to be published on the 27th, by the way. I'm going out of town for a couple of days, and I'll be back next week. So thanks for watching. Bye.